Bank of Australia is expected to raise interest rates for the seventh time in a row. The decision is set to heap further pain on mortgage holders, many of whom are paying more than $1,000 more per month since the record low interest rates in May. And it's prompted concern some homeowners will be forced to sell their properties if they can't meet their repayments. But in the face of sky-high inflation, the Reserve Bank feels there is little choice. Alicia Barry is with me in the studio with more. So, Alicia, what is the expectation? A rate rise, but how big?
Yeah, certainly a rate rise. But a poll of economists shows that 3/4 expect 25 basis points this time around, and around a quarter expect 50 basis points. Now I'm speaking in basis points, but what I mean is half a percentage point or a quarter of a percentage point. So we could either see the cash rate go to 2.85% or 3.1% today, or the RBA could surprise with a different number, but it's very likely it will move in either of those increments. And the inflation figures that came out recently are what moved many economists' expectations for that half a percentage point increase. Many have actually increased the top of where they see interest rates peaking as well.
To where?
Well, what we're expecting is, so you've got people at the bottom, so the economists thinking that they'll peak at around 3.1%, and then you've got economists anticipating that we'll see a cash rate of 3.85% by the first or second quarter of next year, before it starts to come back down to the threes out to 2024. But there is a mixed view, but every expectation now has the cash rate above 3% when you're looking at the economists' views. The markets are anticipating a similar rise up toward 3.5% or between 3.5% and 4%. Yeah. So, I mean, it is a difficult game forecasting, but there's a mixed range of views, but it's certainly on the way up for now.
So why haven't interest rate rises brought down inflation by now?
It is a lagging tool, I suppose. So the inflation figures that we've been looking at, the September quarter figures, show that inflation has hit 7.3% in the September quarter. But obviously we're now in November. So given the lag there, perhaps we will start to see some of those interest rate rises start to flow through to clamping down on inflation in the next quarter. We are expecting, though, inflation to peak at 7.75%. That's the RBA's forecast and Treasury's forecast. It could be even higher than that when we get the latest update from the RBA. But the one thing that interest rates are doing is having a downward effect on home prices.
OK, we'll talk about that more very shortly. But for now, our senior business correspondent, Peter Ryan, is outside the Reserve Bank, where that decision is being made. Hi there, Peter. So that bank, of course, fully focused on getting inflation down. What are the main pressures pushing up prices at the moment?
Well, Ros, simply we have much higher energy prices, as Treasurer Jim Chalmers flagged in the budget. Supermarket prices, petrol prices, the war in Ukraine ongoing, causing havoc around the world, and that's being felt by every person here in Australia. Rising inflation, the Reserve Bank has no choice but to move, given, as Alicia said, inflation annually of 7.3% we saw in the September quarter, higher than most economists expected. The Reserve Bank is already behind the curve in chasing inflation when you consider that the RBA's cash rate was 0.1% back in May. They've got a long way to go, and as Alicia mentioned, that rise of at least a quarter of a percentage point is locked in for today's meeting. I'll also note, while we're waiting for the decision, that
Peter,
the Reserve Bank board is actually meeting away.
We'll come back to you shortly. Alicia Barry has that number now.
Well, 3 out of 4 economists were right. We have seen a quarter of a percentage point increase, taking the cash rate to 2.85%. Even though it's on the smaller end of the scale when it comes to the possible interest rate increases, it still has been a rapid rise in interest rate increases. The trajectory has been very steep. If we look over the last 5 years of interest rate increases, you can see that the cash rate, when we bring up that chart, was sort of, running around that 1.5 level before it came down during the pandemic and then bottomed at the record low of 0.1%. But then since May has just jumped very steeply up to that 2.85% cash rate, which, even going back to 2017, you can see it's still much steeper than people have been used to. And that is playing out for those with a mortgage. Of course, this is going to only increase the amount that people are paying in their monthly mortgage. If you take a look at the $750,000 loan, for example, it's an extra $112 per month, and that's when you can factor in May to November, and an extra $1,100 plus per month that people are having to dig in and pay out to their mortgage. So it's only going to decrease the available amount of disposable income that people have to spend in the economy, which is the idea. But of course, there is a risk that the RBA does go too far and we do see a recession. We'll now bring in Felicity Emmett from ANZ, senior economist there. Felicity Emmett, this was your forecast, a 25 basis point or 1/4 percentage point move. So you're not surprised?
Look, it was there was a risk, obviously, that they might go the 1/2 percentage point given the upside to inflation that came through last week. So we were aware of those risks, but our central case was for a 1/4 point increase today. And that was really based on the arguments that the RBA put forward for why they did choose a 25 basis point rise last time. The fact, as you've just mentioned, Alicia, that interest rates had gone up very quickly, that the cash rate was much higher, had gone than where it was, and that, the outlook for the global economy had deteriorated. So they felt that it was wise to wait and gauge the impact of the rate hikes that they've had so far. So those arguments obviously still stand, and they've gone for another 25.
And so, of course, the RBA still has inflation well within its sights. It made that very clear recently. What do you think it's going to be looking for next when assessing the outlook?
Look, inflation, as you said, is very much a lagging indicator. So I don't think they will be watching inflation so much as to determine when they'll slow down. I think what they'll be looking at largely is household spending. So far, that has remained relatively resilient. Retail sales numbers this week were quite solid, but our own data is suggesting that perhaps we are seeing some slowdown in momentum. They're also going to be watching the global economy and what's happening there, and what they've characterised as wage and price setting behaviour. So whether businesses feel they can pass on price increases and how wage negotiations go in the near term.
And we just brought up a retail sales graph there, which shows just how much consumers have been spending. Obviously, the RBA only has a tool to dampen demand, not supply. Would really like to see consumers pull back a little bit to get inflation under control. What is you mentioned you're starting to see a slowdown. Do you expect that we will start to see a severe slowdown? The RBA today saying that it really is monitoring the global economy and household spending, as well as wage and price setting behaviour, which you pointed to. What's your expectation? Is the RBA likely to go a bit too far here and we could see a recession, or do you think it's on the right track now?
Look, I think the RBA have characterised it very well. There is this narrow path that they are trying to navigate so that they don't put the economy into recession. I mean, so far, the spending has remained quite resilient, and we know that's partly because households have built up very large buffers and savings over the COVID period. So I think we will see spending start to slow as consumers realise they don't have as much money as they used to have, particularly for discretionary items. And we do expect the economy to slow quite significantly over the next year or so. In 2024, we've got growth of just over 1%. So we do expect a slowdown, but at this stage, we think that the economy will avoid recession.
And of course, your bank's expectation is that interest rates will peak at 3.85% in May. You increased that after those stronger than expected inflation figures came out last week. Even with an interest rate at that level, you think the Australian economy can avoid recession?
Look, that's our perspective at the moment. As I said, we think consumers are in quite good shape, but it's something we're watching really closely. And the impact of monetary policy is quite long and lagged. We know that these rate hikes don't flow through immediately to mortgage repayments. So it'll be a really difficult juggling act for the Reserve Bank over the next little while to watch the data and try to keep things relatively balanced. At this stage, we do think even at 3.85 cash rate, we do think we can avoid recession, but it will be, I think, a very challenging time for households in particular over the next couple of years.
Felicity Emmett, thank you so much for your insights and analysis. Appreciate your time.
Thank you.
And Ros, just while we've been speaking to Felicity, I've just noticed the Australian dollar has risen about 1/3% against the greenback. So perhaps the statement from Phil Lowe is a little bit more optimistic than the market was anticipating.
OK, thanks, Alicia. Let's return to our senior business correspondent, Peter Ryan, who's outside the Reserve Bank in Sydney. Peter, so interest rates are up 1/4 percentage point. Can you tell us more about what's in that statement that always accompanies an interest rate decision from the bank?
Ros, a couple of key things. The Reserve Bank Board, in the statement from Governor Philip Lowe, says inflation is still too high. The Reserve Bank Board remains resolute about chasing down inflation. One interesting update is the statement from Philip Lowe says the Reserve Bank, expect inflation to peak at 8% later this year. The original Reserve Bank forecast and Treasury forecast was for 7.75%. The Reserve Bank will be releasing its quarterly statement on monetary policy on Friday, and I'd expect the inflation forecast to be upgraded there. But the final paragraph that we always go to is pretty clear that the Reserve Bank expects more interest rate rises to come. Once again, inflation's too high. They're resolute about chasing it down, so the hiking cycle is far from over, I'd say.
And in this climate, of course, house prices, property prices have been falling. There are figures out today showing the latest picture on that. But to put it in context, prices overall are still above pre-pandemic levels, so aren't they?
Yeah, that's right. House prices in 2021 in the big markets of Sydney and Melbourne rose by something like 20%. So what we're seeing at the moment is a correction, but there's no doubt that house prices are falling back. Philip Lowe notes this in the statement after this afternoon's decision that house prices are falling. Consumption is showing signs of falling back. So this decision today, raising the cash rate by 1/4 percentage point, is in some ways a bit of a wait and see to see the impact of those lagging interest rate rises, and this is the 7th that we've had. It's going to take a little bit longer before we see that full amount of pain inflicted on households. Some households would be feeling that at the moment, of course, with mortgage repayments moving up, but banks are so far reporting little mortgage stress, but people I've been speaking to are preparing for that further down the track, particularly when fixed rate mortgages come off those very low levels and start moving up.
All right, Peter, thanks so much. Alicia Barry here in the studio. Thank you. We are going to Canberra now to the Treasurer, Jim Chalmers.
I'll try and be relatively brief, and I'll only take a few questions given the hour. Today, the Independent Reserve Bank increased the cash rate by another 1/4% to 2.85%. This is another difficult day for Australians who are already under the pump. This means Australians with a mortgage will have to find that little bit extra in their monthly budget to accommodate these interest rate rises. This is about another $50 a month on an average outstanding balance of $330,000. It's about an extra $75 a month for a $500,000 mortgage. I think importantly as well, the Reserve Bank has changed their forecast for inflation. They now expect inflation to peak around 8% towards the end of the year. The Treasury's expectation is more like 7.75%, but they have always said that the risks when it comes to inflation are on the upside, given what's happening in energy markets as a consequence of the war in Ukraine, and given the upward pressure on grocery prices brought about by flooding of some of the prime farmland in Eastern Australia in particular. This is exactly why inflation is the biggest challenge in our economy. This is exactly why inflation was the primary influence on the budget that I handed down last week. When inflation is high and rising and interest rates are rising with it, it's more important than ever that the budget is responsible and restrained and right for the times, and that's what our budget is. We knew when we put the budget together that inflation was high and rising, and that was bringing with it higher interest rates, and that was putting additional pressure on Australians with a mortgage. This is precisely why the budget was designed for dealing with these inflationary pressures, which will get a little bit worse before they get better, but they will get better in time. Higher inflation and higher interest rates coming with it means that the pressure is coming on Australians from around the world, but it's felt around the kitchen table. That's precisely why we took difficult decisions in the budget, showed spending restraint, put a premium on what's responsible and affordable and sustainable. As today's decision has shown, inflation is the number one challenge in our economy. It's the number one focus of the government. It's the number one focus when it comes to the budget that we handed down last week. Well, I think Australians already know that the costs of living are high and getting higher, and the Reserve Bank's new forecast for inflation reflects that. Whether it's the Reserve Bank or the Treasury, the expectation has been for some time that the peak won't happen until later in the year. That is especially so when you consider increases in energy prices brought about by the war in Ukraine, combined with the price of food going up as a consequence of the flooding of some of our best farmland in Australia. And so what we're seeing in the economy with all of this inflation is brought to us from around the world, but the pressure's felt around the kitchen tables of Australia, and that's why the government's focus and the budget's focus is squarely on inflation.
Treasurer,
Matt.
just two parts if I could. Victorian Premier Daniel Andrews has given some very strong statements today about a domestic gas reserve policy. How big a priority would that be for the federal government? Is that something you would introduce? And just secondly, did Tanya Plibersek raise any concerns with you about the stage 3 tax cuts?
The answer to the first question is we welcome input from right around the country, from the states and territories and from the impacted industries when it comes to working out whether we can intervene in energy markets in a sensible and responsible and meaningful way. So we welcome the contribution not just of Labor state governments but Liberal state governments as well. We have said that if there is more that we can responsibly do to take some of the sting out of rising energy prices brought about by the war in Ukraine, then obviously we'll consider that. We are in the process of consulting. We recognise that there are a number of complex interactions here when it comes to energy markets, and so we want to take the time to get it right, but we recognise the urgency too. We welcome comments from premiers of all of the states and chief ministers of the territories, from the affected industries, as we go about methodically coming to the right outcome on gas. On your second question, no.
On the power reservations and the resource reservations, very few Australians would think it makes any sense that 90% of our black coal we dig up in Australia gets exported. Do you think it's time that we look at what the AWU and Dan Walton have said and have a coal reservation too? Because a gas reservation will do very little for power bills, specifically in Queensland and New South Wales.
Yeah, I don't want to think out loud about some of the issues that are being proposed or solutions that are being proposed. Obviously, I engage with Dan Walton, the AWU, with the companies, with our international partners, with the states and territories. I think it's important that people put their views on the table as the government goes about working out the best, most responsible solution here. I'm not going to get into the business of kind of a running commentary on options. I've said that our focus is on the regulatory side in the gas market as it relates to the Code of Conduct and price in particular. This is something that Minister Chris Bowen, Madeleine King, Ed Husic, myself and the Prime Minister are very focused on, that Code of Conduct in the gas industry. There are other proposals being put to us, which is welcome. We've got a big challenge when it comes to inflation in this country, and energy is a big part of it. We recognise that, and if there are steps that we can responsibly take to deal with it, we will. Thanks very much.
That was Treasurer Jim Chalmers in Canberra reacting to the 1/4 percentage point increase in interest rates that's been announced by the Reserve Bank about 16 minutes ago. That brings the cash rate to 2.85%, the highest level it's been at since May 2013. Jim Chalmers noted that the Reserve Bank expects inflation to peak at about 8% towards the end of the year. That was the forecast from the Reserve Bank Governor himself, Philip Lowe. And the Treasurer said the budget last week was designed to deal with inflationary pressures. Inflation is the #1 focus of the economy and of the government. That's the latest from Canberra and the news on the interest rate rise that happened a short time ago.